Welcome. Today we're diving into the scope of IAS 2, the international accounting standard that governs inventories. Understanding what IAS 2 covers and what it doesn't is crucial for anyone involved in accounting, finance, or business operations. We'll explore the types of inventories included under IAS 2, as well as the specific exclusions that are handled by other IFRS standards. By the end of this video, you'll have a clear grasp of how IAS 2 fits into the broader accounting framework and why its scope matters for accurate financial reporting. Start by defining inventory. In the context of IAS 2, inventory refers to assets held for sale in the ordinary course of business, assets in the process of production for such sale, or materials and supplies intended for consumption in the production process. This broad definition ensures that all stages of goods, from raw materials to finished products, are accounted for appropriately. Understanding this definition is the foundation for applying IAS 2 correctly. First main category under IAS 2 is goods held for sale. These are finished products that are ready for customers, such as items on store shelves or completed manufactured goods awaiting shipment. For retailers and manufacturers alike, these goods represent the end point of the production process and are a key component of their financial statements. Properly accounting for these items ensures that revenue and cost of goods sold are reported accurately. Next, we have work in progress, often abbreviated as WIP. This category includes goods that are partially completed and still moving through the production process. Costs such as materials, labor, and overhead are accumulated as these items progress toward completion. For example, a car on the assembly line or a half-sewn garment in a factory would be considered work in progress. Tracking WIP is essential for manufacturers to understand their production costs and manage resources efficiently. Third category under IAS 2 is raw materials and production supplies. These are the basic components and consumables used to manufacture finished goods. Think of fabric for clothing, steel for cars, or flour for baking bread. These items are not yet transformed into final products but are vital to the production process. Properly accounting for raw materials ensures that the true cost of production is captured and that inventory levels are managed effectively. You might wonder why IAS 2 focuses on these three categories. The answer lies in their direct connection to a company's core business activities. By clearly defining what counts as inventory, IAS 2 ensures that companies report their assets and costs in a way that reflects their actual operations. This clarity helps stakeholders, such as investors and regulators, make informed decisions based on reliable financial information. While IAS 2 covers a broad range of inventory items, it also specifically excludes certain assets. These exclusions are important because they are governed by other international financial reporting standards, or IFRS. Understanding what is not included under IAS 2 helps prevent double counting or misclassification of assets, which could distort a company's financial statements. One major exclusion from IAS 2 is construction contracts. These are accounted for under IFRS 15, which deals with revenue from contracts with customers. Construction contracts typically involve unique customer-specific projects and often span multiple accounting periods. Because of their complexity and the way revenue is recognized over time, they require specialized accounting treatment outside the scope of IAS 2. Financial instruments, such as shares, bonds, and derivatives, are another key exclusion from IAS 2. These items are covered by IFRS 9, which addresses their unique financial characteristics. Unlike physical inventory, financial instruments represent investments or financial obligations and are measured and reported differently. Keeping them separate from inventory ensures that financial statements accurately reflect the nature of a company's asset. Biological assets related to agricultural activity, such as livestock and growing crops, are also excluded from IAS 2. Instead, they fall under IAS 41, which deals with the unique nature of biological transformation. These assets change over time due to growth, degeneration, or procreation, requiring specialized accounting rules. However, once harvested, agricultural produce is generally treated as inventory under IAS 2. Once agricultural produce is harvested, it generally falls within the scope of IAS 2. For example, harvested wheat, apples, or cotton are now considered inventory and are accounted for under the same rules as other goods held for sale. This transition is important because it marks the point where biological assets become tradable inventory, subject to the measurement and disclosure requirements of IAS 2. Understanding the exclusions from IAS 2 is just as important as knowing what's included. By clearly separating inventories from construction contracts, financial instruments, and biological assets, companies can avoid confusion and ensure compliance with the correct accounting standards. This separation also helps users of financial statements better understand the nature and risks associated with different types of assets. Recap: IAS 2 applies to inventories held in the ordinary course of business, including goods held for sale, work in progress, and raw materials or supplies. It specifically excludes construction contracts, financial instruments, and biological assets before harvest. Knowing these boundaries helps ensure accurate and consistent financial reporting across industries and companies. Let's look at some practical examples. A clothing retailer's inventory includes finished garments ready for sale, fabric rolls as raw materials, and half-sewn shirts as work in progress. A car manufacturer's inventory might consist of complete vehicles, steel sheets, and cars on the assembly line. Meanwhile, a farm's harvested apples are inventory under IAS 2, but the apple trees themselves are biological assets under IAS 41. Conclusion: IAS 2 provides a clear framework for accounting for inventories, ensuring that businesses report their assets and costs accurately. By understanding both the inclusions and exclusions, companies can maintain compliance and provide transparent financial information. Remember, the scope of IAS 2 is all about capturing the true nature of inventory in the ordinary course of business, while leaving specialized assets to other standards.